All right, I see people trickling in. Awesome. Welcome to what is it? April now. Welcome to the first April edition of the AI Circle. It feels like we haven't done this in a while for various reasons, but I'd argue we probably couldn't have picked a better day to have this. And I wish I could say that there's some sort of genius that had this on the Wednesday, which if you guys followed the markets at all today, this afternoon was quite crazy. And honestly, we've had a crazy year. So just a great time to have this. Hopefully, a lot of people are able to join us live and ask any questions that they might have. Of course, this will be posted as a recording after. If anyone would like to watch it again, or even if they miss it live, you can still ask us questions on the recording. So let's welcome in Kelly. Kelly, I'm sure you can hear me. How are you?
Recovering from a long flight back from
Yeah,
on the other side of the Atlantic,
yeah.
but I'm
You,
feeling okay.
as you said on a call earlier today, whenever you leave, it seems like the markets get crazy.
And guess what? I think this is probably the most crazy time. It was fine up until last week. Well, sort of fine. And then, well, we're about to talk all about it.
Yeah, absolutely. And before we say anything, we've always got to get our disclaimer out of the way. So, I Flip Investor Inc. and I Flip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak with your CPA or financial representative to ensure the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With all that being said, here's our typical agenda of market update. We've got some great trades to talk about. I know at least one off the top of my head. I'm sure you guys have plenty of questions. I have some that I've kind of accumulated, I guess, over the last few weeks for this that I'll also ask Kelly. But if you guys do have questions, it's going to be a pretty action packed call tonight. So get those in as early as possible. And I guess if we have any spillover, we'll cover it on the next one. So that's kind of the agenda. Kelly, I'm going to turn it over to you. Would you like your screen share? Do you have anything to say first?
Uh, well, I'm going to share the screen and then say. So I think you can put it up there. Fine. Hopefully, does everybody see that? Let's get it as big as we can. All right. I think, look, wow. By the way, it's good to be back. I think the last time we did one of these was at least 3 weeks ago, if not 4 Wednesdays ago. Um, Obviously, a lot has happened over that same period of time. But if the last one we did was in early March, the market was sitting around 41,000 in the Dow and 42,000 in the Dow. And as we sit tonight, it's at 40,600. So you would think, oh, not much has happened. But obviously, a tremendous amount has happened. And one of the most important things I think everybody should know is, or anybody that's even listening to this this afternoon, is why are you at Flip? I mean, what is the real reason you are here? And honestly, our OMS, it's our order management software, which allows you to both buy and sell stocks like anywhere else, and also buy and sell complete portfolios of stocks as well. And inside those portfolios, they're managed by a computer. That's the one main difference of our platform versus other people's platforms. And when you pick our smartfolios, most of those smartfolios are designed to manage risk, which means they're designed to manage what's going on right now and has been going on in mass over the last week in particular. A week ago, on April 2nd, I remember we had a sell signal. I was away, but we had a sell signal in the S&P 500, and we got out of the market somewhere around in the S&P somewhere in the area of about, call it 558. In the very next day, the market gapped lower and was down 4%. And the very next day, it was down another 6%. And the very next day, it actually was down at one point another 6%. So within 3 days of getting out of the market had lost 10%. And the major position we have in all of our smart folios, the balanced, the conservative, and the aggressive, is the S&P 500 Spider, where we have large allocations to it, 20%, 25%, 28% allocations to just one symbol, which represents the broader market as a whole. This is the way portfolios should be constructed, where it's not a big basket of stocks that we just buy and hold, which is what 99% of the investment public does. What our portfolios are is to say we're going to go with a smaller basket of stocks, maybe 15 to 20 stocks, but one of those stocks is going to be something we're really going to focus on and have a larger allocation to. And when we do that, that means we're going to move that particular one market. In our case, it's this S&P 500 Spider, is what we use to gauge how we own the rest of the stocks in the portfolio. And it's also what we use to be able to manage the risk in a heavy way, heavy-handed risk management, when the market is perceived to be going lower. In other words, what's that mean? It means if the computer thinks that there is going to be more risk over the next 10 days than there is reward, why would we be in the market? Get out. So on April 2nd in the morning, we did get out. And whoever owns any of our three major portfolios and some of the others would notice that a huge part of their money went to cash. And I'm going to tell you another piece of news, if you haven't looked. This morning on the open, we bought back that exact same position of the S&P 500. I have to say that the computer itself, I would have never done that myself. No way. I did manage money many years ago, as many people know. That's not what I do anymore. What I do is write software. And the software literally bought this morning when the market was lower. I mean, I was even dumbfounded on the trade. I was frightened for that trade. Oh no, I think this isn't a good time. And as usual, I'm wrong. So if anybody thinks I'm a good market prognosticator, please don't think that, because I am just not as good as the math. I would have never placed that trade. And that's the thing. A computer can make the hard decision that you can't, or even I can't. It buys and sells based on data. It doesn't have an emotion, as we all know. And it's really times like this where you can really say that, and it's meaningful, because obviously no one walked in today thinking that there was going to be some news item that would move the market literally up 10% on the day in the S&P. And by the way, in the last 45 years that I have really been following the market, and I have been following them that long, I have never seen a day like this. I've never seen an up day of 10% in the S&P. A 5% up day in the S&P is amazing. It's something what I would call a 4 sigma event. In other words, 4 standard deviations away, which is less than 1% of the time. 0.5% if it's up, or another 0.5% if it's down. Today was 10%, so it's almost an 8 sigma day. And that's what we call it, 8 sigma. 8 standard deviation. Sigma is standard deviation. And That means it rarely, if ever, and in my case, I've never seen this, happens. And it happened today. And we just happened to get long the S&P. If you look in your accounts, you should see a buy order for SPY, and you know that you bought some. And that means in this particular case, it looks like we bought a low. And so the more important thing, though, is guess what? We got out of the market 10 days or 5 days ago, and it went down 10%, and we weren't in it. And I will admit that we got lucky, I think, even though this code does this, and we bought the low and we made 10%. So where everybody else would be just even, we made 10%. And by the way, we didn't experience the downside. But let me go dive into this a little more deeper. Even if we didn't buy the S&P today, you would have avoided the angst. You have to understand, you would have avoided the angst of the market going down. There is no reason to panic. I'll give you a few reasons why. First of all, the S&P 500 going down 15% year to date at one point, which was, by the way, earlier this morning, or actually Monday morning, is it's a big move, yes, but it's really not a lot. I mean, a much more stronger move down would be more like 20 to 30% lower. And we've seen some of those over the last, 5-6 years. COVID was one. 2018 trade war, Christmas trade war was another. 2022, we kind of angled ourselves lower to be down 25% at one point, and then we closed down for the year 20%. So, that is more of a significant move. What makes it most scary, though, is when it happens over 3 days. When most money is lost over a 3-day period, everybody takes notice. It's all over the news. It's talked about all over every pundit station. If you have something to say, Democrat, Republican, Independent, they're going to be talking about it. It's going to be Armageddon on one level, and it's going to be opportunity from another level. Who knows what it is? But I can tell you that the reason everybody should be on our platform, and I mean everyone, not just you, the people that are listening, and the ones that are not, that are on our platform, it should be really everybody, because every investor out there can maneuver the markets better. And to those people that say you can't time the market, I mean, this is a bold statement, but, well, we just did. We sold the market before it went on the S&P, before it went down up to 12%, and we bought the market when it was down that same 12%, and we wrote it back up. If you don't call that timing, I don't know what timing is. But let's just say for a second and step back and say, suppose we didn't buy the market this morning. I'm going to go back to that. Either way, we would have avoided the down move of 12%, and we would be no better off today than we were a week ago. The difference is we didn't experience the pain that everybody else did. I'll give you an example. The big tech portfolio, right? Big tech is what really moved this market down. Big tech, of course, is the Mag 7, the Magnificent 7 stocks. We all know who they are. I'll quickly run through them here because we've done this before. Here's Apple. I mean, this is, obviously a well-known stock. It's moved down from these peaks, which were at the beginning of the year, to these lows, was down around 25%. Look at Amazon. Very similar. Peaks early in the year, February, all the way down to here, 240, 160, losing $80 on a 240. That's down 30%. Google, similar from these highs to these lows, 30%. Meta, nowhere near as bad, but still down about 20 from peak to trough. Netflix was the one that hung in there. Look at this. Netflix barely went down. It was from 1,044 to 840. So you can say it lost maybe 15% at its worst. Microsoft, look at Microsoft. That was down over $100 from its high. But here is at 440. We got down to 340. So we lost $100. It's about 25%. NVIDIA, even though it rallied today, I'm very anti-NVIDIA. I think NVIDIA is going down to 80 or lower, but for different reasons. But either way, it was down huge. It was down over 30% from its peaks to its trough at one point. During that point, though, of all those big tech stocks, Flip had sold out of all of them except for one, Netflix. So Netflix is the one stock that is still owned inside the big tech smartfolio. And it's because these stocks we've been getting out of over the last number of months for various reasons. The other day I did a calculation. I took all of the Mag 7, including Netflix, all of them, and I said, hey, year to date, what was the drawdown at that one point on Monday? And I calculated it from just year to date, which is better than where the peak was. It was down 18.5%. Well, if you look at our big tech portfolio, it was down 6.9%. Just call it 7. So really, we saved about 11.5% of the loss. So if you had 100 grand in there, you would have lost 7 grand with us. But if you just owned those stocks, you would have lost 18,500 on us on those same stocks. Obviously, you would rather lose 7,000 than 18,500. That's the difference. That's why you're at iFlip. It's to protect that. And over time, the math, AI, algorithm, we like to call it AI, but we just should call it the math. The math will start getting us back into these stocks. And as you can see, other than Netflix, all these stocks are still nowhere near their highs. They're just nowhere near their highs. They had a huge rally today. Here's Apple's rally. Look, 15% in a day. Look at NVIDIA, 18% in a day. Microsoft, a huge company, 10% in one day. Meta, 14% in a day. But even with the 14% rally on Meta, it is still 590, what is it, 585 a share, but the high was around 725 a share. It's still $150 off its high. Look for these things to go back long sometime soon. And as long as we can maintain these prices. So again, fundamentally, we must understand when the market goes down, especially significantly, it takes much more movement up percentage-wise to recover a loss. So for example, if you lose 50% of a stock loses 50%, to go back to even, you got to make 100%, right? In other words, I bought something for 100, it goes down to 50, it loses 50%. For 50 to go back to 100, it has to go up 100%. It doesn't work that way. If you're down 20%, then you have to maybe make up 24%. But it works on a curve. So if we know this, we know that the job always should be, if you're a good money manager or a good trader, is to really manage the risk. If you can manage the risk, the reward will come. And then we can count on the fact that the market does go up over time. Otherwise, why should there be stocks? And we can use that to our advantage, but we can also use that to be able to maneuver inside the market and maybe outperform the market over time, which is what we really expect to do. But I always look at the outperformance, not just in making more money, but also on taking less risk doing it. So that is my mantra. I see things coming in, but this is really, really important. So let me, I haven't wasted. I think I have spoken wisely, hopefully to everyone listening for the last 20 minutes saying, espousing why you want to be on our OMS. Why is our platform valuable? Our platform is valuable because you really, if you look closely, you don't have to worry that if the headlines say the market's going down, it's crashing. You should be able to open up your portfolio at Flip and not be afraid to look. I can't tell you how many times I've had people saying, "Oh, I just can't look. I can't look." And then they start saying, "It'll come back. I know that. I just won't look right now," because they don't want to feel the pain. Well, I can tell you, I look and I see pain all the time, my own, but I see the pain of my software that we wrote, and we have spent tons of time making it work and testing it and making sure it's doing what we expect. That is the real work. It is, I've always likened it to a boat. If you have a ship and you know you're going to carry people on it, if you have any repairs or things you want to do them in dry dock where nobody can be hurt. But once that ship goes out to sea, you can't change anything because it's out to sea. It's not my job then or our job, and you wouldn't want me to be doing this, tweaking a system or saying, no, I can fix it and make it better while we're all in the boat and the water is deep and cold. I'm not that guy. We have to do these things when we have time and the markets are docile. And all we really do is make sure that our systems are running the way they're supposed to, and that they're getting all the data that they receive is accurate, and then trying to improve them by adding new data, not by trying to tweak the inner workings of the code itself, but to make sure that, hey, if we give it more data, maybe it can make even a better decision. And those things are additive automatically. They're not done by me. It's not subjective. It's just done through the math. So let's get to, I think it's important to just kind of do a quick overview of the markets. And I'll do this one pretty on the quick, maybe within 8 minutes. Look, here's the Dow Jones, everyone. Dow Jones basically started the year right around 42,500. Well, we're about 2,000 points off the high. So that's about, if you want to look at it, that's only about 5% off the high. I mean, where we started the year. That's only 5% now. Now, we were higher, so we're still down more than that from our peak. But year to date, you can say, hey, we're down 5.5%. The S&P 500, pretty much the same kind of story, down a little more. We came into the year right around 5,800, 5,890, or just call it 5,900. We're at 5,450. So we're down about 8% here year to date, but we were down much more. And if we didn't have a 10% rally from our highs, we were right at the bear market area, which is down here. But it bounced off of it. And again, we bought below today. So again, hooray for us. But don't think that that's going to happen every time. Although I will say over the last 3 times that this kind of thing happened, we did buy below. So that has to be thrown out there. What was really going on overnight that scared everyone? Here's the thing. It was the bond market. And you don't see it here. These are bond futures. But what was really going on overnight, and you don't see this because of the way this future trades in an aftermarket, the 10-year note right here is trading at about 4.4%, right where it is closed today. And at the peak of the down move, when the stocks were getting destroyed, the 10-year note in terms of price was here, but that was about 4%. In other words, interest rates dropped, which is the normal relationship. As stocks go down, especially under panic, people flock to the safe haven of treasury notes. Well, something really weird happened over the last 2 nights. You don't see this here, but the 10-year note actually traded all the way up to almost 5% last night and coming into Monday. In other words, literally Monday morning and Tuesday, the bond market was so dry that there was times where some of these bonds could be picked up close to a 5% yield. In other words, the price was much, much lower than you see on the screen here. And that is because of the way they trade in the aftermarket, something called the EFT market. So that scared Treasury and Besant. In some ways, everybody, I feel that they used this as an excuse to be couched it in the fact that there's 70 countries that are saying we're going to make a deal. So Trump comes out, and this is just my opinion, but here's why it's the AI circle and I can't opine. What I think really probably happened was Scott Bessent went to Trump and told him that the bond market is in real trouble here. We need a way to relieve the pressure on the bond market. And the way to do it was to say they're going to put a temporary pause in the tariffs, because we know the tariffs started this. But what they did is they couched it by saying, look, there's 70 countries coming to us and we're going to negotiate a good deal. And that's very much probably the case. But when I just look at what really happened behind the scenes and knowing what I know and the people I can talk to, I can tell you there was probably more to it than what meets the eye. And that unfortunately tells me, everyone, that we should be prepared for more volatility. We were close to up 3,000 points today, and we were close to up 474 points on the S&P in a single day. Don't be surprised if there is a lack of follow through tomorrow and we take some of these gains away. That being said, I do think we've probably set the low. And if I was a trader going forward, any move back down, I would buy and I would defend it by saying if it goes lower than the old lows, I'm out. So that's the way a trader would look at it. He would be buying somewhere around where my mouse cursor is, if you can see it, if they can get a good price like that. And then they can say, look, I'll risk 4%, but I think I might be able to get 8% on a move back up. So that's the question. Where is that buy zone underneath? On the other hand, if there is further follow through tomorrow, which we did close on our highs, you can suspect that there would be some people that might want to sell into that and say, hey, oh my gosh, I'm so thankful that I have an opportunity to get out of the market with so much smaller of a loss. And so there's going to be a lot of that. So in other words, we're going to have volatility on the up and the down, at least for another week or so, until something starts to settle in. I do think that they're not going to go back on these trade issues and the 90-day pause. The only holdout is China, but that's fine. That'll kind of work itself out over the next month or so. And I think for now, we have put in a low, which is good. And if we can start to trickle higher, you might start seeing some of some buy signals again in the stock market and some of these issues, which, by the way, I think would be good ones because we now have defendable lows. So that's really a good thing to note. One of the other things I think is worth noting, and I'll start to sign up, we've already gone through the Mag 7, which is an amazing move. The oil markets deserve a conversation here. The oil markets fell out of bed. Basically, we know that oil basically was trading around $70 a barrel for quite some time. Look how steady it's been going back to October, November, even in the beginning of the year, it got, kind of towards 80, fell back down into the real price point, which is right around 70, right around where my mouse is. But then we fell out of bed from $70 a barrel all the way down to actually touching 56, almost 55.50 a barrel earlier today, closing at 62.70. So it was up, almost $4.50, but it's not really that. It's that this is what I call a dislocation. A dislocation is oil lost from 70 to 56, about $15 a share. So that's about 22%. Okay. The high tech stocks lost about the same, but the S&P 500 lost much less than that. Why did the oil stocks lose so much? What happened to the demand? The reason that the oil markets lost so much was because when the stocks fall precipitously in so quickly, what happens is people feel that, oh no, demand destruction, which means we're going to go into a recession. If we're in a recession, everything kind of shuts down. Less people work. If they work less, they don't drive as much. They don't go to the grocery store as much. They take less travel. They don't travel as much. So all aspects of energy kind of get cheaper. Not our electric bills, unfortunately, but consumable gas, natural gas, and things we use, jet fuel, things we use for transportation go down precipitously. If the market is put in a low, which I suspect it has, that means this market will likely rally right back up to $70 a share over the next couple of weeks. And the reason is because that would be the fair value of where the prices were in the stock market literally just a week ago. This has not recovered as much as, for example, the S&P 500. So I suspect a further rally in the oil energy markets of at least another $5 a barrel over the next, maybe by the end of the week. So this is kind of what I suspect would happen. And I would be long oil here all day, all year. And I know that I think our chance to go to 70 a barrel is much stronger, which is another $7 to $8 higher than it is to go down below 60 a barrel. So that gives me something like 2 to 1 on a bet. So I think the energy market is deeply oversold, and I think that that's going to rebound. That speaking, our favorite stocks like Energy Transfer, they were annihilated over the last week, and they just haven't recovered because oil hasn't. But if they recover, we go from its current price here, 1670, back to around 19, very, very quickly. Again, I still feel these stocks are going to $24 a share each. This one and All Plains American. They're both going here, which is still an incredible value in my mind. And we remain long those in the conservative and red oil portfolios. Finally, there's just so much to look at. I think we can kind of put a little compendium on it. We probably should look at Bitcoin. We'll look at it in terms of the IBIT. Bitcoin, of course, put on a huge rally today too, up 7.5%. You know, one of the prices for IBIT has been around $50 a share. At $50 a share, we're looking at about 90,000 on Bitcoin. So 94,000 on Bitcoin. So this is something that I expect to recover right around to at least here, which is, you know, still another 5-6% higher before it makes a decision. If we can hold in the stock markets, again, can hold the lows that we put in earlier, literally today or yesterday, this has a good opportunity of resuming and just languishing around for the rest of the summer. And then maybe towards the end of into the beginning of the third quarter, we take off and start to make our moves back to the old highs, which in the case of this proxy would be somewhere around the $60 a share area. Beyond that, there's a million things I could talk about, but I think I've run my mouth enough for everybody to hear. And Lee, let's do a little Q of A.
Yeah, and unfortunately, your camera is frozen.
Somebody just should have said something. But
no,
okay.
you're good. We can hear you just fine. So behind the scenes, everyone, we had some difficulty getting on today. My camera wasn't working right, and then the audio was all bad. So I'm like, let's de-risk this and make sure that the audio is all good and everyone can hear us. And if you don't get to see our faces, then it is what it is. Maybe just
pleasantries for everybody else.
Maybe just to recap, you know, obviously the volatilities through because of tariffs, etc. If those are paused, for 90 days and they're going to revisit it, who's to say that we're not going to have the same problems that we are right now before today was announced that they're going to pause them? Like, should people expect that in 3 months to be the same type of thing?
It's excellent question, and that's why I suspect further volatility. Remember, the first response to the 90-day pause was this enormous rally, which does make sense. This
Sure.
was something that could come. But it's very much sort of like the federal government kicking down the road, a reconciliation bill for the budget. Oh, let's just delay it another 30 days, 90 days. They kick the can down the road. But during that kicking of the can, other things can be resolved and sometimes makes it easier to resolve it, 90 days from now. That being said, I agree with the question's tone does that mean we're still going to have the same problem 90 days from now? No, we're going to have that problem during the 90 days it takes to get to the 90 days, which means expect further volatility. And as the news comes out, some of the news is going to be, more threats. Some of it's going to be, hey, we made a deal with these countries. There's going to be good things and bad things. And that's going to create the volatility that we're going to see, especially over the next week or so. We're just not out of the volatility. When a market goes up 10% in one day, I think everybody knows that means it could also go down 10% in one day.
Yeah.
And we're just not out of the woods yet. The day in the reason we aren't is because partly is because the markets that are this volatile just don't stop the volatility instantly. But the other reason is that there's going to be more and more news out now that we have this can kicking time that is going to affect the market. And that volatility, it'll trail off after a week or so, but it'll still be there. And underlying this, people will be nervous. There are sellers above the market, but we also know now there's probably buyers underneath. The sellers will be more firm at first, and they'll keep a lid on any larger gains. But it tells me that we will probably, if we're going to see new highs in this market, it's not going to be in the second quarter. It's going to be a consolidation, hopefully in the second quarter, where the lows are in, and the trade tariffs, as we get closer to the 90 days, those questions will start to be answered diplomatically, and we'll already know that, how Trump decides to respond to it by saying, we will not tariff Vietnam, we will not tariff Bangladesh, but we will tariff Canada. So those kinds of news items are going to move the markets. And so all we had today was a reprieve, something people were looking for, to feel like, okay, we have some sense that we can still own stocks.
Sure. Maybe to get out of the tariff conversation, but when you went to Bitcoin, it made me think of something. Since really forever, it seems like Bitcoin's been called like it's uncorrelated to the markets, right? And it seems like this year, Bitcoin's basically performed identically to what the markets have. The market has a good day like today. Bitcoin, MicroStrategy, et cetera, does great. Do you still think it is that, or has that always just been false? I guess that it's a decorrelator.
It is not a decorrelator.
Yeah.
It is a alpha generator. You can't really look at Bitcoin, and if I've ever said that it's a decorrelator, then the better term for that is it's an alpha generator. It doesn't trade precisely like the stock market. It does. The correlation is kind of low, actually. It's about 0.45, something below 50. In other words, Bitcoin can move its own way with very little impact from the stock market. But however, when the stock market starts to go down, pretty much all everything goes down.
Yep.
There are no winners. And why is that? Because people look to see what they have assets in and what is liquid, and they sell everything. This is a case where they throw the baby out with the baby water. And when, again, under a panic situation, it's always been said that all correlations are one. everything is for sale. Everything, even your mom's precious necklace, everything is on the block. So I think going forward, Bitcoin will maintain its low correlation to the stock market. But when you think of owning it, you really think of, hey, you know, maybe 5% of that, 3, 4, 5% of that could, you know, is something that can maybe go up 10, 15 times. And what does that do to my, you know, to the 95% of the other stocks that I own? It means, hey, that one stock can make a huge difference in your overall return. That's why we own it.
Yep.
We don't own it there to protect us like a bond.
Right.
We own it for the extra alpha.
Yeah, I wouldn't think of Bitcoin as something that's a nice, safe bond-like thing. I did see, maybe speaking of bonds, and I think I read this morning, the TLT, it was either 2 or 3 days in a row, it lost more than 1.5% for the first time in like maybe ever. Of course, it came back just like you were showing on the chart there. I haven't seen any real questions. Maybe we answered or kind of covered them all indirectly. If you guys do have other questions, I'll do a last call for them now. But Kelly, I don't know if you want maybe in a couple sentences just to recap everything, if that's even possible. Obviously, you know, there's volatility. It's probably, you know, the 90 days still going to be volatile.
Yeah. I'll just recap it. And very simple, everybody. The reason you're here, please, I want everybody to really examine it. The reason you're here is because you know that the risk is going to be managed and you don't have to worry and call up your broker, which, you know, we're the OMS. We're not the ultimate broker, but, you know, you would call us and say, should I get out? Obviously, we can't tell you anything like that, but just know that the reason you're here is because the software is managing risk. So you should not lose as much as the market if the market goes down.
Yep.
So that's number one. And number two is we're going to have volatility going forward. There's just no doubt about it. 10% days up or down are followed by at least, you know, 3 and 4% days subsequently. So forgive me, hold on.
Oh, you're good. No, I think, I mean, exactly what you're saying. You know, this is what we're designed for, right? This is the minority of the time, I would say, in the market. You know, as Kelly always says, the markets are designed to go up. You don't need to worry about that 8 or 9 out of 10 times where things are going great. This is kind of the important times, and this is why you use something that values risk management like our platform does. There was one question, I think it's, and if you had a comment to say, go ahead, and I'll ask the question.
Well, I guess I see a lot of people out there, and most of which I know, is that my final comment is the markets will recover through this. And I will say this, this reminds me of Christmas 2018 when we had the Chinese trade war. We got out of the market on the S&P at that time around November of 2018. The market hit a low on Christmas Eve. Why? Because Trump did a tariff right on China, a heavy one, and you know quickly the market went down over 20% within like 12 trading days. Very much like what we just saw, but more in terms of percentage. And then on the day after Christmas, the market trickled back up, and then it turned out by the end of January, the whole 20% was recovered. This kind of reminds me of that. The difference is it's much broader in scope. It's not just China, it's the whole world. And today will go a long way if we listen to the news tonight, it will be all over the place about what is going on, and the volatility will be in the markets and in the news just as much as it is with all of us. We all get volatile when the markets are volatile, and the main thing is to, just relax through it. Have a glass of wine, understand what it is. These things will pass. The markets will move higher. There is no structural damage to any of these companies. And these trade things will be worked out, and it's not going to be zero trade, zero tariffs everywhere, but there will be a more reasonable tariffing between countries with the US and against the US, that'll be more acceptable, and it will be better for the country. It's just, it's just something I guess we have to all go through when you have a president that says that we should go through this. And whether we agree with him or not, that is just a reality. If he does it right, it's going to be an incredible victory for the country and the stock market.
The one question I did see that I thought was worth bringing up here from Connor, basically along the lines of the AI, how does it differentiate between short-term market noise and long-term trends, especially in the context of, news like, quite frankly, like today when Trump says, hey, we're going to pause these tariffs?
Okay. Really good question. Honestly, it doesn't know what Trump is going to say. It doesn't know if, there's going to be a COVID outbreak. It doesn't know that, a tariff will be implemented by surprise, on Friday. It doesn't know that. The way it works is that there's a measurement of future risk versus future reward. And you're looking for the reward to be greater than the risk. In other words, if the reward is on the numerator must be bigger than the denominator. In other words, it has to be greater than 1. When you see it less than 1, you shouldn't be in the market. In other words, if I have to risk $1.20, the denominator, to make $1, why would I do that? Unless I had a huge high probability that I'm going to make the dollar. And if you think of it, the market on a day-to-day basis is a toss of the coin. It could be up, it could be down. Well, if that's the case and the probability is 50-50, I at least need the risk to be less than the reward. That's how it works. So it's not predicting a tariff or a statement from the government. There's no way I can get that data in fast enough. There are some, just a quick side note, there are some parsers that used to do that back in the 90s and early 2000s, where they would parse a Reuters data feed, for example, and look for keywords and then be able to try to execute trades based on that. That all failed. So
I would also argue that sort of stuff impacts more of a trader type person versus, like, we're here to invest and manage risk, quite frankly, over time.
Excellent point, Lee.
Is it fair to say that when the AI gets us into something, it's usually thinking the foreseeable future, meaning I'm not going to put a time frame on it, but it's probably a pretty decent time to be invested?
It's generally 45 days. Just so you know, we do kind of coast out for like 45 days. So we really like to think the next month and a half we're going to be higher.
Right.
There is a time thing on that. And by the way, there's several of them, but it works out to be about 45 days.
I'm just thinking of the one maybe misconception people, when they first hear about us, they think we're a trading type platform. We're going to make a lot of trades and things like that. And that's just not necessarily the case. I guess times like right now, we've kind of seen some, but they've all been, they've had good reasons, I guess, but behind either getting in and sometimes even getting out as well. So I just wanted to cover that last question. I thought it was very valid to bring up. Kamal and some others that have said hi in the chat. Steve from the start.
Hi,
hello,
Kamal.
everyone. Thank you guys for being here. I don't have anything else unless you do, Kelly.
Nope, nothing else for today.
Awesome. Well, we'll plan to be back here in the next 2 weeks. So April 23rd, if I have the date right. But 2 weeks from today, we should be back here unless something unforeseen comes up. But I'm sure we'll be talking about a lot of the same stuff we have today. Again, feel free to bring your questions to that one, and we will see you guys in another 2 weeks. So have a great rest of your night. Thanks for being on today. Kelly, thanks for the words of wisdom as always. And everyone take care.
All the best, everyone. Take care.